What is going on, you guys? Welcome back to another video. Chances are, if you clicked on this video, you're kind of wondering what is the number one way to transfer your current wealth down to the younger generation. That could be your kids, that could be other relative family, but ultimately, how do you safely and efficiently, tax-wise, pass all of your wealth down to your children, essentially? Now, what could be your wealth? It's really everything. It could be estates that you have, could be different businesses, possibly investments, other types of assets, maybe vehicles, boats, buildings, property, addresses, stuff like that. I see a lot of business owners make this mistake, and the reason why I say business owners is because typically people who have really large assets in terms of value to pass down, they typically run businesses. Now, I do have a few clients where they got their wealth from their parents before them, and so on and so on. Others just came across it, stuff like that. So everybody's situation is different, but ultimately the most common case that I see is they are running some kind of a successful business, and the business has assets, investments, and just overall cash flow inside of it. The reason why I brought that up is the most common case that I see is these business owners or individuals will do up a will, and in that will they will state child A gets X, child B gets Y, and child C gets C, or person C, or whatever. They've got a very specific layout of where they want their assets to go and who they want their assets to go to. Now, that's good. That's the first step, but that's not the whole picture, and that's what a lot of these business owners and individuals miss, is they make these wills and they think that they're set, and that's only the first play. Once you make a will, there's a second step that you have to take, and by not taking this step, it puts your entire estate, your entire value and net worth, and everything that you have at risk. And you might be wondering, well, at risk of what? Well, quite literally anything and everything. Now, I'll give you a prime example, and this is a situation that I saw unravel over a number of years, and I'll tell you why. My company had this client, and what happened was this client had a value, let's just call it $1 million. It wasn't $1 million, it was a lot more, but just for sake of conversation and confidentiality, we'll just call it $1 million. So this client wanted to give $1 million to the client had 3 children. 2 of them he was close with. The other one kind of strayed away from the family values and family line and kind of went out and did the wrong thing, and the relationship wasn't that great. The one child was going through addictions. They were hanging around the wrong crowd, getting involved in the wrong scene. And to give that child a chunk of the net worth, which would have been like $200 or almost $300,000, would basically be asking for trouble, or essentially a suicide note. Now, what this client did is they did up a will, and inside that will, they said, I want to give client C, the one that was going through a rough patch and was going through all of these addictions and wasn't staying within the family path. They said, I want to give this child $50,000, but they can only take out $10,000 a year, or it was 6 months, or whatever the terms was. Now, with that said, the other children will get their values in trust, but they can take it out whenever they want. There's no limit. They can take the whole thing out now, or they can take it out $50,000 every single year until the fund has run out, and that's essentially it. So what happened was the third child was very upset and was very jealous, and what actually happened was that third child went and got a lawyer, and they sued that will, and they took him to court. And to keep a long story short, this court case went on for about 6 or 7 years, I think. But because of that client's mistake of not having that one missing piece, and I'm going to tell you what that is in just a second, not only cost them a lot of money, because when you take someone's will and estate to court, the estate pays for it all, at least at the start, and usually once it's over, usually within the terms and conditions of the deal being closed or an agreement coming to light. Typically, everyone agrees that the trust, or not the trust, but the estate pays the tax, or sorry, not tax, but pays all the lawyer fees, court fees, stuff like that. So what happened was, because the client never did the final step, which is introduce a family trust, they were able to sue the estate and the will, and they were able to get a lot more than $50,000, and they had all of their legal fees paid for by that estate. Now, what that did was, first off, that dragged on for about 6 or 7 years around that rough timeline. That put such a big strain on the family where it drew their family apart, and it really caused a huge ripple. Because you've got siblings suing each other, you've got lawyers involved, and there's a lot of money that's on the table. And it really drew them apart. So essentially it's tearing down a family. On top of that, it's very expensive. It's very costly, and the estate pays for it. So that client's wealth that he wanted to pass down, it caused a huge ripple inside of his family, and the value of it also went down because he was now paying essentially for all of the fees. Now, what this client ought to have done was to introduce a family trust. Okay, if you were to introduce a family trust, you still have a will. The will writes it out, okay? The will makes it clear on what's happening. But the trust is almost like a clear concrete patch that goes over top of it, meaning no one can break it. Nobody can sue that estate. Nothing can be done. I believe off the top of my head, trusts have an expiry of 20 years, but you can add in a clause or something where after the 20 years expires, it then renews, it automatically renews, so it goes for another 20 years. Anyways, so if that client had a family trust in place, what would have happened was that third child, that third son that wanted to sue the estate and testify that will, then they would have taken it to court, and the judge would have looked at all the paperwork, and essentially, not literally, but essentially, the judge would have been, sorry guys, there's a family trust here, and according to the family trust, this is what the will wants, so this is what's happening. Nothing that I can do about it. You can't sue the estate, you can't do anything. Sorry guys. And in fact, before it even got to that point, the son would have went to the lawyer, and the lawyer would have said, there's a family trust. We can't do anything about it. Having a family trust, like I said before, is like a clear coat of concrete going over your will. So nobody can break it, nobody can challenge it, and nobody can do anything about it. And not only does the family trust protect you and your entire estate, but it's excellent for different tax planning opportunities. I'm not going to get into it because that's not the topic of this video, but essentially it is extremely well for tax planning, especially getting the Canadian lifetime capital gains exemption. So if you have an estate or assets or a business or anything of that sort, and you want to safely and guaranteedly transfer it over to your children, maybe a family member, someone of the younger generation, you just want to transfer it over when essentially you pass away, and you want to be guaranteed that it gets to that person or it's distributed the way that you instructed, and you want to guarantee that nobody can challenge it, nobody can sue it, and you want to guarantee that it's not going to lose its value, then a family trust is what you need. Now, please, for the love of God, do not go and set up a family trust, because it has to be structured in a certain way. And maybe where you're at in your current business cycle or life cycle, a family trust doesn't make sense and it will only cost you money, but maybe something else will. Maybe a bear trust might. Maybe a holding company might. Who knows what your current situation is? That's why you always have to consult a professional before you go ahead and deal with these kind of things. And when I say professional, I'm talking about someone who specializes in trust specifically. Now, that's what my company does. My company specializes in trusts and estates. So if you wanted to find out if a family trust is relevant to your current situation or if it's even beneficial, then what you can do is you can go ahead and tap the link down below, and you can pencil in a time that works best for you, and I'd be more than happy to sit down with you and go over some different strategies and some different game plans. At least by taking that call, you know for a fact and you're guaranteed, okay, I'm either on the right track or I'm not on the right track. And if I'm not on the right track, here's how to get on the right track. So ladies and gentlemen, thank you very much for watching. If you found a little bit of value in that video, I want you to go ahead and drop a like on this video. And with that being said, I will see you guys in the next one.